Hi there, welcome to Terra Firma Business and Financial Consultants, our YouTube channel. My name is Robert Wolf. I'm the founder and CEO. I'm an asset coach and a tax strategist. If you haven't subscribed yet, go ahead and hit down the subscribe button. Go ahead and gray out the bell so you get updates and notifications when we add new videos and new content. If you like what you hear, go ahead and hit the little thumbs up, and please feel free to add comments. The comments help the community, help us to become better at what we do and provide more content for you, small business owners. So today's video, I wanted to focus on some things that have come up when I work with different advisors, whether they're tax attorneys, CPAs, enrolled agents, life insurance agents, financial planners, money managers, commercial property and casualty brokers, group health insurance brokers. These are all the people that we work with. Also some business brokers that do buy, sell businesses as well. So really any advisor, any center of influence, anybody who has contact to you, the small business owner. And one of the things I get asked a lot of times is, well, how do we start a conversation? What's the most important thing to understand from the IRS's perspective? Now, remember, this is just for educational purposes. I'm not a tax professional. I'm not a CPA, enrolled agent. I'm not a tax attorney. This isn't financial advice either. Okay, what I'm trying to do is just provide some information, education to kind of view things from the IRS's perspective. These are lessons we've learned and how we help our business owners, whether they're our clients or another advisor's clients. At the end of the day, we start every conversation with this question. If you had the choice, would you prefer to increase your taxable income or your tax-free income? Okay, sounds like a silly question, but the reality is everybody says tax-free. The interesting thing is, since we were young in high school all the way through college and a trade school or whatever kind of education you went to, or you didn't, you just went into starting your own business. Whatever the case may be, from high school to now, we've been taught one way. And the one way is to generate and create taxable income. And it makes a lot of sense because who needs the tax revenue? The government does. The government is a business. And so when we understand that and we acknowledge that, and the IRS is the collector of that, they're the bookkeepers, right? So you're a business owner, you have a bookkeeper, they do the accounting, they do the collections, your accounting department takes care of that, and that's what the IRS does. Now, here's the interesting thing about this whole process is that if you want tax-free income, how do you get it? Since nobody's been teaching it and we haven't been taught it, well, I can't say nobody's been teaching it. The information's there, but it's not readily available. We have to understand the IRS code. Now, it's like any contract, insurance contract, business contract, or anything you're not certain of. It's written in English, but when you get done reading a paragraph or a sentence, you're like, what did I just read, right? It's a different dialect within the English language. It has its own dialect. And so we got to understand what they're trying to tell us. And what I want to do is provide a little of that information today. Okay, so here's how we educate our business owners and those that we talk to. When we look at it from the IRS perspectives, they look at assets. Okay, and that's what we need to understand. And Robert Kiyosaki in his books does a great job, especially in Cash Flow Quadrant, describing and explaining what an asset is. It's something that generates income. So you, as a taxpayer for the U.S. government, are an asset. You generate tax revenue income. Okay, you also generate income for yourself, whether you're doing it through a W-2 wage or you own your own business like you do, you earn W-2 wage and profits and distributions from your business. Okay, either way, you are generating income. Every asset does that. So you look at real estate, investment real estate, it does it. You look at 401k plans, pension plans, it does it. You look at your business, it does it. Okay, so the IRS views each of these assets differently from 3 stages. And so let's talk about those 3 stages. The first stage, we like to call that the investment or contribution stage, where you start up the asset. So you go buy a piece of property. Well, you got to put money into it, whether it's a down payment, and then you borrow the rest of the money from a bank or somebody else, and you purchase that asset. Okay, boom, there you have it. The IRS views that, recognizes that from a tax perspective on that stage. Okay, now, sorry, a little pause there trying to figure out how I wanted to transition that. Now let's take a look at a different thing besides real estate. Let's look at your business, right? You put money into your business, all right? Same thing. Now, what you put money into is considered your cost basis, right? That's your principal, so to speak. So if you add money to your pension plan, as an example, right? It's a tax deduction. You're not taxed on your contribution or your initial investment. Okay. Now, the moment you enter the first stage, the investment or contribution stage, you immediately enter into the second stage, which is the accumulation or growth stage. The point of an asset is to appreciate. Okay, that's why it's considered an asset. Now, a liability is the opposite, right? So now you may buy that asset, like I explained with real estate, with a loan, and that loan part is a liability, but that's an accounting feature. The IRS doesn't view that aspect. What are they concerned about? The asset itself. And the growth, are you earning money to where it creates income to be taxed? So for example, a brokerage account. You go buy stocks, bonds, mutual funds, ETFs, okay? And you buy a stock, you sell that stock, and there's a gain, okay? That is how we're taxed. Okay. Now you can say that is also entering the third stage, which is distribution. Okay. Because you exited that asset, and so you generated income or distributed from that. Okay. And so that's the third stage, and that would be taxed. Okay. So for example, a pension plan is tax deductible, meaning that you're not going to be paying a tax on the front end. Okay, from an income perspective on your paycheck. The second thing is it grows and accumulates tax deferred, meaning you're not going to pay any taxes on the growth. Notice I use the term deferred. You're deferring, and if you haven't paid taxes on the front end, you haven't paid taxes on the middle, where are you going to pay taxes? On the back end. So when you start distributing and generating that income, you're going to be taxed as ordinary income, whatever tax brackets you're at that point. So that's kind of the three stages. Every asset goes through that. Okay. Now, how do I get tax-free income on the exit, the distribution, the income, right? That's the whole point of why we have an asset. And if I want tax-free assets, how do I do that? Well, there's no silver bullet. There's no asset that hits all three stages, right? The IRS needs to generate revenue at some point and some asset in that process. Okay. So one asset isn't going to accomplish all that. But a plan utilizing assets based on the rules those assets go by or play by, so to speak, you can actually generate a tax deduction, you can grow it tax-free, and you can distribute tax-free from your overall plan. We use the process, what we call the 3 Ds. Now, if you go on the IRS website, in the search menu, you type in 3 Ds, it's not going to show up anything. No search results. This is our translation of the IRS code, that dialect, okay? And so the 3 Ds are this. The first D is deductions, okay? Which asset provides the most tax efficient or the best deductions? And that's your business. The tax code really is designed for you and your business. Well, why is that? How can you say that, Bob? Because I always feel like I'm overpaying taxes. Because you're overpaying taxes on the income from the business, whether it's a profit from a C Corp or a taxation on the pass-through to your personal tax return, that profit going to you, okay? But the key here, though, is understanding that the IRS wrote the tax code for you as business owners to be able to reduce your tax liability. Why? Well, because think about it. If you have more cash, what are you going to do with that cash? You're going to put it back into your business. You're addicted to your business. The IRS, the government knows that, right? This is your blood, life. This is your baby, right? It's your child. You're going to put more money into it. And when you do that, what happens? It starts growing, right? Hopefully. And when it starts growing and you're wearing every hat, can you keep wearing every hat as you're getting busier, busier, and busier? No. So what do you have to do? Hire employees or independent contractors to help. Okay. And the cash flow quadrant, Robert Kiyosaki's cash flow quadrant, talks about this. So that tax revenue from a W-2 employee is the tax revenue the IRS is looking for. It's consistent. There's not a lot of ways to reduce your tax liability on your personal 1040. Okay. So it's consistent revenue, just like you and I as business owners are looking for consistent revenue. So that's the first D, deductions. Okay. Hopefully that was helpful in explaining that. The second D is depreciation. What asset provides the most depreciation? Well, that's real estate. Now, let's take a step back. You can make the argument in your business, let's say your manufacturing company, and you purchase a piece of machinery. Yeah, you can depreciate that piece of machinery, but it's not as efficient as real estate. Okay? Here's why. When you look at your 1040, go to the Schedule E, the first page. That first page is for real estate. Okay? And if you don't have any real estate as an investment property, so you don't have that first page of Schedule E, you just have your business, which would be on Schedule E, page 2, go to the IRS website, and what we'll do is we'll actually link a PDF of the Schedule E to this video, okay? And open it up, and when you look at it, it's going to say revenue, income, okay? So it may say rents, all right? Same thing. That's the revenue that you're generating, rents, right? Because it's an investment property. Then right below it, after royalties, it's going to say expenses. And it's going to have a list of expenses. The last expense on the bottom before you get to total expenses, the last expense right there is depreciation. And what word is right after that word depreciation? Expense. They don't put the word expense under any of the other expenses, but just that one. Why? The IRS is giving you a clue. Okay? It's a reward. It's like playing a video game. It's a treasure chest. When you open it up, you get tax-free income from your piece of property. Okay? Now, the depreciation is based on the structure of the property, not the land. Okay? It's not the market value of what you bought the place for. It's the structure. Okay. Now, internally, appliances, cabinets, different things on the inside of the house or the investment property also have a depreciation schedule. Okay. This is great because this is an expense that you're not adding additional dollars to like you are with advertising or insurance or anything like that. Okay. This is something the IRS, the government, gives you as a gift. It's that treasure chest. It's free gold, so to speak. All right. So we want to look at that. So that's why I say, yes, you have the expenses. You can deduct those expenses from your real estate property, which you can with your other business, right? But it's not as efficient because you can't do tax planning with real estate. You can do tax planning in your business. Okay. Now we can do depreciation, which is tax planning. And there's different strategies with regards to that we can talk about in another video or we can discuss that another time. Now, those are the two D's so far. Deductions, depreciation. Well, what's the third D? Distributions, right? Distributions, income, the whole reason why you have an asset. How do I get tax-free assets? Notice the three D's are in the three stages. Deductions are in the beginning stage, the investment stage, the contribution stage, when you're trying to grow your asset, your business. Notice the second D, depreciation, it's as you're accumulating, growing your asset. Okay? The third D is distribution. That's your income. How do I get tax-free income? Well, there's only a handful of assets that allow you to do that. Okay? Now, you can make the argument that Roth IRAs allow you to do that. And that's true. Now, there's certain income limitations and rules with Roth IRAs that we can discuss in another video and another time. But the reality is, yes, it's income tax-free, but it's not completely tax-free. Okay? Now, the municipal bonds are a great example as well. Well, how much money do you have to put in there to generate an income stream that's of value? With interest rates being historic lows, with experiencing 2008 and seeing how counties, cities, and states were affected by the financial crisis, municipalities need investors to invest money, absolutely. But do you have enough to invest to generate 3%, and that 3% is good enough revenue? Yes, it's tax-free. But what happens if there's a bankruptcy in that county or that city, right? That there's that risk to it. Now, I'm not saying it's a great risk, but we saw that in the 2008 financial crisis. You can make the argument, looking at statistics and economic numbers today versus 2008, we're in a worse situation today than we were back then, okay? And so, is it safe enough to do that? Probably, probably not. That's a decision, and through your advisors and more due diligence, you have to figure out. Remember, we're not giving investment advice. This is just giving you some education and understanding. So what other asset provides tax-free income? And you can use equity out of your house or your piece of property or your real estate by borrowing equity out of your real estate. That's a non-taxable event. But more efficiently, because you're relying on a bank, you're relying on interest rates, or you're relying on the ability to be able to borrow money out. So there's a lot of factors in the underwriting process of real estate. And then when there's economic downturns or economic issues, what's the first things banks do? They stop lending, let the dust settle, and then they start lending again. Okay, so the most efficient asset in the third D of distributions is cash value life insurance. Now, there's many different types, and it really depends on your situation and what you want to accomplish and your advisors and the overall plan. But we like to utilize cash value life insurance as a tax-free asset to be able to accumulate tax-free, to be able to distribute income, borrowing the cash out of the policy, just like borrowing equity out of real estate. It's a non-taxable event. And so we'll have more, we can do another video later on to discuss the features of cash value life insurance and the benefits. But I just wanted to kind of give you a holistic view of the three stages of an asset, which is what we talked about: the investment contribution, the accumulation growth, the distribution income. Those are the three stages and how the IRS views those. Okay, every asset's different. So if you want tax-free income, you got to understand those 3Ds. Then, the 3 stages, and then we go into the 3Ds, right? Understanding those. And how do we build out a plan to be able to utilize those 3 assets, or some of those 3 assets, or all of those 3 assets in an overall plan? And that is how you're able to generate a tax-free income and be able to hit all 3 stages in a tax-efficient manner by utilizing the rules of each asset, how the IRS looks at those, the rules of those assets outside of the IRS when it comes to laws and regulations and all that fun stuff. So very, very important. Great stuff, exciting stuff. So if you do want tax-free income, there you go. You got to focus on the 3Ds. Now, how do you do that? That's a different conversation. So hopefully this was very helpful. Again, if you like this content, give us a thumbs up. If you have any comments, questions, or whatever, concerns, go ahead and put that in the comment. Again, that's going to help the community. As a small business owner, you're sitting on a treasure trove being a business owner. Now the key is to making a couple of little tweaks, looking at a couple little visuals. You all have a tax guy, you all have an attorney, you all have other advisors. The key is, how do we get them all to work together so you can get that tax-free income? All right. So thanks again. My name is Robert Wolf. I'm a asset coach and a tax strategist with Terra Firma Business and Financial Consultants. Make it a great day.